Home Depot stock, ticker symbol HD. This stock is down 23% year to date, which is quite a lot of course, especially since the overall market is down 17% year to date. On the 15th of November, Home Depot presented quarterly results, where they beat on both EPS and revenue. The stock went up 3.6% after earnings. However, for the upcoming earnings, 18 out of 25 analysts voted a miss. And of course, the reason why people love HD stock is because of the dividends. Dividend yield of 2.4% and a very low payout ratio. The dividends itself are also growing in a decent amount. But does this also mean that Home Depot stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Home Depot does, the most recent earnings, the historical results, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does HD do? Home Depot is the world's largest home improvement specialty retailer, operating more than 2,300 warehouse format stores offering in the United States, Canada and Mexico. It stores of numerous buildings materials, home improvements, lawn and garden products and decor products and provide various services, including home improvement, installation services and tool equipment rentals. If we dive in the earnings report, we see that Home Depot reported sales of $38.9 billion, an increase of $2.1 billion year over year, or 5.6%, which is pretty good in my opinion. Comparable sales for the third quarter increased 4.3%, which is of course a very important number. Home Depot can increase the revenue quite easily by opening a new store. But you also want them to see organic growth in the already existing stores, so that's why you need to pay attention to comparable sales. Net earnings were $4.3 billion, or $4.24 per diluted share, compared with $4.1 billion or $3.92 per share in the same period of fiscal 2021, representing an 8.2% increase in diluted earnings. And keep in mind that this number is growing in higher amounts than the revenue itself. So that's really nice in the case of Home Depot. But a thing to keep an eye on are the customer transactions. It's decreasing 4.3% year over year. But due to higher average sticker sales, an increase of 8.8% year over year, the comparable sales is up. So next time you want to see both numbers up. The company also reaffirmed the 2022 guidance, comparable sales growth of 3%, which is lower than the 4.3% they just reported. But take a look at the operating margin, 15%, which is really nice. It's increasing quite a lot, which we will see later in this video as well. Diluted earnings per share growth to be mid-single digits, which is pretty good. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you'll receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Home Depot is a $319 billion market cap company, which makes them one of the larger companies in the US and the biggest company in the do-it-yourself store industry. PE ratio is at 17.7, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for Home Depot, so make sure to watch until the end. Revenue is at $160 billion, and in this graph we see that revenue went up really nice and steady. But keep in mind that during the lockdown periods, revenue really took a jump, and it's highly likely that revenue will start to slow down to pre-lockdown growth numbers. Net income is at $17.97 billion, which gives us a profit margin of 11.2%, which is above the 10% minimum. And keep in mind, this is also one of the things that I like about Home Depot versus competitors. Margins are really steady, and the highest in the industry. We also saw in the earnings that it's expected that net margin is going to be around 15%. EPS is also going up really nice and steady and is in line with the revenue growth. So this comforts me a lot. Revenue and net income are increasing in similar numbers, and on top of that, Home Depot is buying back shares, which we will cover in a minute. But first, the price to sales ratio. We want this number to be between 1 and 2, and right now Home Depot has a price to sales ratio of 2. So this is the good part. But the thing that I don't like here is the fact that it's increasing a lot in the past couple of years. Price to free cash flow is too high in my opinion. Right now it's around 29, and you want this number to be below 20, so keep an eye on this number. Analysts are expecting EPS to increase single mid digits, which is pretty good in my opinion. But for the revenue they are expecting low single digits growth, which is something that worries me a bit. Return on assets is sitting at 16.4%, which is really nice, and above my 10% minimum. Return on equity doesn't look good, to be honest. But the most important number, return on invested capital, is looking really good at 23%, which is pretty high. But the thing that I don't like here is the fact that it's lower than the 5-year average of 26% again. So again, keep an eye on this number as well. Current ratio is at 1.39 right now, which is pretty good. You want this number to be below 1.5, so I'm feeling very comfortable with Home Depot sitting at 1.39. Another thing that I don't like about this company is the total debt number. It's sitting at 49 billion, and to me it's very important that a company can pay down at least 33% of the total debt. Right now, total cash is sitting at 2.46 billion, and operating cash flow is at 13 billion. Levered free cash flow is sitting at 7.2 billion. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in this graph we see that free cash flow is growing really nice and steady, so this comforts me a lot. The big spike and decline afterwards doesn't worry me that much, since it's more in line with the previous growth levels. Another thing that I really like are the shares outstanding. We want this number to decrease, and in this graph we see that it's decreasing really nice and steady over a longer period of time. I really like this because it increases your ownership in the company, increases earnings per share as well, and on top of that the PE ratio will decrease. And it's easier to maintain and grow the dividends, since less total dividends are paid. And since we're talking about dividends anyway, Home Depot has a dividend yield of 2.4%, which is really nice in my opinion. It's not the highest of course, but it still pays you a decent amount of money. Annual payout is at $7.6 a share and payout ratio is at only 11%, meaning they have 89% left in cash to buy back shares, pay down debt, do acquisitions and a lot of things, so I really like this low payout ratio. The 5-year growth rate is also very nice at 16.95. They are growing the dividends in high amounts, which is a good thing. Home Depot grew the dividends for 12 years in a row, which is also pretty nice. Overall, a great looking scorecard, but how about the historical returns versus the S&P 500 and their main competitor? I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include Lowe's, since this is the main competitor for Home Depot. On the 5-year chart we see that both stocks easily outperform the S&P 500. Home Depot has a 109% return including dividends, versus the 68% return for the S&P 500. Lowe's had the highest return with 185%. On the 1-year chart we see a minus 21% return for Home Depot. The S&P 500 and Lowe's performed similar with a roughly minus 14% return. On the 6-month chart we see a 11% return for Home Depot versus 2% return for the S&P 500. Lowe's is again the winner with 15% return, doing slightly better than the Home Depot. On the 1-month chart we see an almost 10% return for Home Depot, which is the highest in this list. The S&P 500 returned 6.7% and Lowe's returned 8.6%. Overall I think Home Depot did very well, especially versus the S&P 500, which is the overall market in this case. They have beaten the S&P 500 in almost every scenario. But does this mean that Home Depot is still a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 3% for the low assumption, 4% for the mid assumption and 5% for the high assumption. Profit margin is likely to increase according to what we saw in the earnings report, but also according to the historical growth numbers. So I'm filling in 11, 13 and 15%. It's the same story with the free cash flow margin. I'm filling in 10, 11.5 and 13%. For the PE ratio and price to free cash flow, I'm filling in 16, 17 and 18. Home Depot is a slow growing company, so that's why you want to pay a lower number here. On the other hand, Home Depot has a moat in my opinion, and they are the biggest player in the industry, so that's why you want to pay a higher PE ratio. Bottom line, these numbers seem to be the most justified here. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Home Depot is at $313. I hit analyze, and we see a few green numbers. We have a low price target of $203 to $223, which is a big drop, roughly 30 to 40%. We have a mid-price target of $259 to $293, and we have a high price target of $326 to $376. To me, the mid to high numbers are the most justified here, based on what we analyzed, analysis estimations, and the most recent earnings. So that means a big range of $259 to $376. My final conclusion on this company is that I really like the business and a lot of parts of the stock as well. But to be honest, you are maybe paying a premium for this stock right now. And this could be reasonable, of course, since you get a solid stock in return with decent earnings, great dividends and a moat. But on the other hand, there's no much growth potential, so you have that to keep in mind. From a dividend perspective, a great stock, but from a value point of investing, you maybe want to wait until the stock drops below $290, which is pretty reasonable in my opinion. Right now, Home Depot is one of the bigger investments in my portfolio. I keep collecting the dividends, and whenever the stock drops, I will buy more shares. My average stock price is around $290, which is in line with the mid-price target. So it would be great if the stock drops and I can buy at lower prices. For now, I'm just waiting and analyze this company from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.